Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Fuller HB Co. quarterly report. H.B. Fuller Company provides a wide range of businesses and services through its three segments: hygiene, health and consumable adhesives, engineering adhesives, and construction adhesives. The company's offerings include specialty industrial adhesives for packaging, converting, nonwoven and hygiene, health and beauty markets, high-performance industrial adhesives for durable assembly, performance wood and textile, transportation, electronics, clean energy, aerospace and defense, appliance, heavy machinery and insulating glass markets, products for tile setting, commercial roofing, heating, ventilation and air conditioning, insulation applications, caulks, and sealants for the consumer market and professional trade. These products are sold directly to customers or through distributors and retailers in various regions worldwide. The decline of H.B. Fuller Co.'s stock price over the past year can be attributed to a combination of factors. The company's weak business performance and challenging market conditions have been major contributors, with the CEO acknowledging weak overall market demand conditions persisting into March 2025. Several key events have also contributed to the decline. H.B. Fuller missed analyst expectations in its Q4 2024 earnings report, citing a challenging market environment and higher raw material costs. The company's Q1 2025 results showed significant headwinds, including a decline in net revenue and adjusted EBITDA. In the third quarter of 2025, H.B. Fuller reported a revenue miss and tightened its full-year guidance, leading to investor concerns. These events have collectively contributed to the stock price dropping by more than 25.44% over the past year. The primary drivers of revenue growth or decline can be attributed to four key factors. Firstly, increases in product pricing have led to revenue growth in various segments and periods. Conversely, decreases in sales volume have negatively impacted revenue growth in some cases. Additionally, mergers and acquisitions, M&A, have contributed positively to revenue growth across multiple periods. Lastly, currency effects have also played a significant role, with positive or negative impacts on revenue growth due to changes in exchange rates. These factors collectively influence the trajectory of revenue growth or decline. Net income and profit margins. A year of contrasting trends, the financial performance of a company has shown mixed results in terms of net income and profit margins. In Q3 2025, net income increased by 16.7% compared to the same period in 2024. However, on a year-to-date basis, YTD, net income was down by 0.4%, or up by 16.2%, depending on the source. Profit margins have also experienced fluctuations. The gross profit margin rose by 200 basis points in Q3 2025 and by 90 basis points for YTD 2025. In contrast, segment operating margins showed a decrease of 50 basis points, or an increase of 180 basis points, in Q3 2025, while YTD saw a decline of 230 basis points, or an increase of 140 basis points. The reasons behind these changes are attributed to the company's share repurchase program and segment reorganization. Additionally, higher product pricing and the impact of acquisitions/divestitures have contributed to the fluctuations in profit margins. The company is experiencing a significant issue with its operating cash flow, as it has been generating negative operating cash flow. This is evident from the calculation on page 34, which shows that the total operating cash flow is minus $71.2 million. The breakdown of this figure reveals that while net income is $122.3 million, other expenses such as changes in net working capital and accrued compensation are outweighing these gains, resulting in a negative overall operating cash flow. This trend suggests that the company may be struggling to manage its finances effectively, which could have long-term implications for its stability and growth. The company's debt level and interest expenses have undergone some fluctuations over the past year. While the total debt has increased from $2,010.6 million to $2,080.5 million between November 30, 2024 and August 30, 2025, the net increase in debt level was only $60.7 million in 2025, indicating a relatively small growth. In contrast, the company experienced a significant decrease of $176.8 million in its debt level in 2024. Regarding interest expenses, there has been a mixed trend. On one hand, interest expense decreased by $1.7 million in the third quarter of 2025 due to lower interest rate margins. However, on the other hand, it increased by $0.9 million in the first 9 months of 2025. Overall, while there have been some changes, they are relatively minor and do not indicate a significant shift in the company's debt level or interest expenses. Management is optimistic about the company's outlook, emphasizing its ability to defend against lawsuits while focusing on strategic resource allocation and growth initiatives. Key strategies include vigorously defending against claims in the Rouse et al. V. HB Fuller Company lawsuit investing in a global ERP system, Project One, to support growth and improvement repurchasing common stock, and making permitted acquisitions using borrowings on their revolving credit facility management, is confident that cash flows from operating activities will meet both short-term and long-term liquidity needs, ensuring sufficient funds for operations, capital spending, and other purposes. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In recent years, the company paid out $37.6 million in dividends in 2025 and $35.4 million in 2024. Additionally, it also invested in buying back shares, with $60.7 million spent on this initiative in 2025 and $39.4 million in 2024. Concerns about inventory buildup or supply chain disruption exist. The company's financial summary raises red flags regarding its inventory levels and supply chain management. With an unusually high 91 days of inventory on hand, it suggests that the company may be holding onto excess stock, potentially indicating inefficient inventory management practices. Furthermore, changes in inventory have resulted in a significant use of cash totaling $71.2 million, implying potential issues with managing inventory effectively. These concerns highlight the need for the company to reassess its supply chain and inventory management strategies to prevent disruptions and optimize resources. That concludes the financial summary for Fuller HB Co. Feel free to comment below, and I will be happy to answer them when possible.